All right, lean in. In December 2024, a company called CoreWeave tripped a wire inside its own loan agreement. Not because it missed a payment, because it moved GPU servers to the wrong country. Blackstone, one of the largest private lenders on Earth, had structured a $7.6 billion loan around the physical location of computer chips. And when CoreWeave shipped those chips to the UK and Sweden without telling anyone, the entire facility went into technical default. That's the world we're in now. Lenders tracking the passport stamps on a graphics card. Now let's slow it down.
For most of the last 2 decades, the biggest technology companies on the planet didn't need to borrow money. Amazon, Microsoft, Alphabet. These are businesses built on software margins and advertising revenue. The cash came in faster than they could spend it. Data centers were expensive, but they were funded internally out of operating cash flow quarter by quarter. No lender sitting across the table. Then generative AI changed the arithmetic. Training and deploying large models requires a different kind of infrastructure. Dense clusters of specialized chips, each costing tens of thousands of dollars, housed in facilities that draw enough power to run a small city. By mid-2025, AI-related investment was contributing materially to U.S. GDP growth, and the spending projections ran into the hundreds of billions, just on data centers. Even for companies sitting on enormous cash reserves, the numbers stopped working. The capital requirement of the AI race began to outpace what these companies could generate internally, and equity financing, selling stock to raise the difference, was too dilutive in a volatile market, so the industry turned to debt. In 2025, AI hyperscalers issued more than $100 billion in corporate bonds, most with maturities beyond 5 years, locking in funding for multi-year construction cycles. Credit spreads began to widen, reflecting the sheer volume of new supply and growing uncertainty about whether these investments would ever pay off. What made this borrowing possible was a piece of collateral logic borrowed from real estate. Lenders weren't underwriting the AI thesis. They were underwriting the chips. A rack of NVIDIA H100 GPUs bolted into a data center had a market value. It could be appraised, tracked, and seized. The chip became the building. The lease became the mortgage. And CoreWeave's covenant breach proved it wasn't a metaphor. The covenants tracked where hardware could move and which entity held it. The default wasn't about cash. It was about geography. The AI boom isn't just a technology story anymore. It's a credit story.
Keep that in mind, because this river of debt had to go somewhere. And to keep it from showing up on public balance sheets, the system had to build places to hide it.
Start with CoreWeave, the company from the opening. When it needed billions for GPU clusters, it didn't borrow directly. It created subsidiaries, dedicated legal entities that entered the loan agreements and held the GPU servers. The debt was collateralized against the hardware. CoreWeave guaranteed everything unconditionally, but the borrowing entity was the subsidiary. The assets and the liabilities sat one step removed from the parent. Because CoreWeave was preparing for an IPO, the numbers became public. Its amended S1 laid them bare. Total indebtedness by the end of 2024, $8 billion. The first credit facility carried an average interest rate near 14%. 14%. On a loan backed by hardware that loses value every quarter. The risks didn't stop at the interest rate. In 2024, 62% of CoreWeave's revenue came from a single customer, Microsoft. The company also disclosed material weaknesses in its financial controls. But here's what matters. CoreWeave was the version you could see. The IPO forced disclosure. The hyperscalers don't have to show you any of that. When Amazon, Microsoft, or Alphabet need AI infrastructure without loading debt onto their own balance sheets, they take the structure further. They create joint ventures or special purpose entities. Vehicles where the hyperscaler holds a minority stake, sometimes alongside private credit firms, insurers, or pension managers. The hyperscaler commits to a long-term lease or capacity agreement. The vehicle raises private debt, secured against the data center hardware. But because the hyperscaler holds a minority position, the vehicle's debt doesn't consolidate onto the parent company's financial statements. The Bank for International Settlements called these arrangements shadow borrowing, obligations economically equivalent to debt, but living outside reported liabilities. On the hyperscaler's books, investors see a lease expense, an operating line item. What they don't see is the billions in debt sitting inside the vehicle that the hyperscaler effectively controls through its lease commitments and guarantees. And banks provide funding lines to these vehicles, meaning the risk doesn't stay sealed inside a private credit fund. It connects outward through the banking system into the credit markets the rest of the economy depends on. For the ordinary investor, someone holding these companies in a retirement portfolio or an index fund, the balance sheet looks strong. The debt ratios seem manageable. What they can't see is the architecture underneath.
This entire architecture runs on one assumption, that the payments keep coming, that the lease revenue covers the interest, that the customers keep spending, and that the hardware holds enough value to back the loan. When any of those things break, the system doesn't default. It does something quieter and more dangerous.
In 2024, CoreWeave spent $941 million servicing its debt. Roughly a third of its operating cash flow gone before a dollar went toward growth. And CoreWeave was the best-case scenario, a company with hyperscaler contracts and real revenue. Across the broader private credit market, hundreds of billions in loans sit with borrowers under even greater pressure, including legacy software companies whose products are now being displaced by the same AI technology this debt was built to finance. So what happens when a borrower can't pay? In most markets, the answer is default. The lender takes the loss. The company restructures or dies. But private credit has a different tool. It's called a payment-in-kind toggle, a PIK toggle. When a borrower can't cover its interest payments in cash, the lender doesn't call it a default. Instead, the unpaid interest is converted into additional principal. The loan gets bigger. The borrower stays current, on paper. And the lender's portfolio doesn't take a write-down. Think of it like a credit card where the bank lets you skip the monthly payment, but adds the interest to your balance. Next month, you owe interest on a larger number. The month after that, even larger. The debt compounds quietly. No alarm. No headline. No bankruptcy filing. Just a balance that keeps growing. The International Monetary Fund classified these PIK switches as a form of selective default, arrangements that technically keep borrowers alive while avoiding formal failure. And when the IMF measured borrowers' ability to cover interest using only actual cash payments, stripping out PIK, the share of companies that couldn't meet their obligations was meaningfully higher than the headline numbers suggested. And that's what makes this dangerous. The fund reports stable performance. The borrower reports current payments. The portfolio valuation holds. But underneath, the principal is growing. The interest that wasn't paid in cash has become new debt that accrues its own interest. The hole deepens without making a sound.
Before we continue, one thing matters here. The silicon mortgages, the hidden vehicles, the interest traps, all of it rests on one final assumption, that the chip at the bottom of the stack is still worth something, that when the lender checks the collateral holds. That's the question that decides whether this system bends or breaks.
Every layer of debt we've traced, the silicon mortgages, the off-balance sheet vehicles, the PIK toggles compounding in the dark. All of it depends on one physical question. How long is a GPU actually worth something? The industry has an answer. It's called the value cascade. The argument made most clearly by infrastructure analysts at the QB Research goes like this. A high-end GPU doesn't just do one job. It moves through economic phases. In years 1 and 2, it runs the highest value workload, training large AI models. In years 3 and 4, it shifts to production inference. By years 5 and 6, it handles batch processing and analytics. Each phase earns less, but the chip stays productive. The hyperscalers structured their books around this logic. Amazon, Google, and Microsoft all extended server depreciation from 3 or 4 years to 6 years during the early 2020s, spreading costs over a longer period and boosting reported operating income. The QB Research argued the schedule was reasonable. If the hardware still generates revenue in year 5, 6-year depreciation reflects economic reality, not accounting fiction. That's the defense. Now here's the attack. Princeton Center for Information Technology Policy published a direct rebuttal. Their argument, the value cascade ignores variable costs. It doesn't matter whether an old chip can still run inference workloads if the electricity required to run it costs more than the revenue it generates. And with each new generation arriving roughly every 12 to 18 months, the efficiency gap widens fast. NVIDIA's Blackwell series is roughly 25 times more energy efficient than the H100. Once those chips scale into production, running an H100 in a power-constrained data center becomes uneconomical at any rental price. Princeton also challenged the secondary market. For 6-year depreciation to hold, there must be enough downstream buyers to absorb used chips at meaningful prices. But most enterprises rent capacity from cloud providers rather than building their own infrastructure. The secondary market exists, but it's a fraction of NVIDIA's primary data center revenue. And when new chip generations flood the market faster than demand can absorb them, resale values don't hold. They crater. The market data backs the skeptics. At the peak of the AI boom, H100 rental rates exceeded $8 per GPU hour. By December 2025, those rates had fallen to around $2. The older A100 rented for about $1.35. 2 generations of chip, nearly the same rental price, both barely covering electricity and depreciation. There was almost no margin left. That convergence is the signal. When 2 generations of hardware rent for nearly the same price, and that price barely covers the cost of keeping the machines on, the market is telling you the older chip's economic life is effectively over. The revenue it generates no longer supports the debt that was taken out to buy it. If depreciation moves faster than the loan schedule, the collateral goes underwater. The lender holds a claim on hardware the market won't buy at the price the loan assumes. And in a market where billions in private credit are secured against GPU racks, a broad decline in chip values doesn't just hurt one company. It transmits through the SPVs, through the funding lines, through the banks, and into the credit system that the rest of the economy depends on. That hasn't happened yet. The loans haven't matured. The next generation hasn't fully scaled. The lag between accounting depreciation and economic depreciation is still widening. In the background where most investors aren't looking.
That's the system, a constraint that forced the most profitable companies in history into the debt market. Structures designed to hide that debt from public view. An interest mechanism that lets the debt grow when borrowers can't pay. And a collateral assumption that depends on hardware holding value in a market where the next generation makes the last one obsolete. None of these pieces are broken, yet, but every one of them is load-bearing. And the question isn't whether the AI boom is real, it's whether the financial architecture underneath it was built to handle what happens when the math changes. That's the system. See you in the next one.